Have you ever looked at the standard retirement age of 65 and thought there must be a better way than working for 4 decades just to enjoy the last few years of your life? Retiring in just 10 years sounds almost too good to be true, especially in today's economic climate. But the reality is that achieving financial independence and retiring early is completely possible if you are willing to make strategic, data-driven decisions with your money. In this video, we are going to break down the exact, actionable blueprint to accelerate your retirement timeline, taking you through the math, the savings rate required, and the investment strategies you need to implement in USD to build a robust portfolio that can support you without requiring you to clock into a 9 to 5. Whether you are starting from scratch or already have some investments, understanding the compounding power of money and the principles of aggressive savings will transform your mindset and equip you with the tools to take control of your financial destiny. So keep watching until the very end to discover the exact plan you can start executing today. Part 1. The math behind retiring in 10 years. Achieving early retirement in a single decade relies heavily on the 4% rule and your personal savings rate rather than relying on pure luck in the stock market. To understand the math, you must look at the multiple of your annual expenses required to sustain your lifestyle indefinitely without working. The standard guideline states that you need a portfolio that is 25 times your annual living expenses to be financially independent. For instance, if your household spends $50,000 USD per year, your ultimate target portfolio becomes 1.25 million USD. This number might sound intimidating at first, but when you break down the compounding mechanics, the goal becomes much more achievable through consistent contributions and a disciplined approach to asset accumulation. The engine of this mathematical equation is your savings rate, which measures how much of your after-tax income you retain rather than spend on consumables. If you save 10% of your income, it takes over 40 years to retire because your spending rate is 90%, meaning your capital works slowly. However, if you increase your savings rate to 50%, the timeline shrinks drastically because your expenses drop and your investment contributions double. In fact, saving 50% of your income allows you to reach financial independence in approximately 17 years. And if you push that savings rate to 60 or even 70%, you cross the finish line in a decade or slightly less. The math proves that cutting expenses has a double impact, as it simultaneously reduces the total amount of money you need to generate while leaving more capital to be invested. To make this work in your specific scenario, you need to calculate your current annual expenses and determine exactly how much capital you must deploy each month. Assume you earn 100,000 USD per year and spend 50,000 USD, which means your savings rate is 50%. To reach the 1.25 million USD target within 10 years, you must invest about 5,000 USD per month, assuming an average 7% inflation-adjusted annual return in a broad market index fund. This level of contribution requires aggressive budgeting and a deliberate focus on optimizing your taxes and living costs. Understanding these numbers transforms retirement from a vague age-based milestone into a strictly mathematical formula that you can track, adjust, and achieve with absolute certainty. Part 2. Aggressive savings rates and lifestyle inflation. Achieving a decade-long retirement timeline requires shifting your financial baseline from a consumer mindset to an aggressive accumulation mindset. A standard savings rate of 5 to 10% might protect you against emergencies, but it will never generate the momentum necessary to replace your active income within 10 years. To achieve this, you must push your savings rate to 50% or higher of your total after-tax income. This level of savings forces you to audit every single dollar you spend and prioritize future freedom over current consumption. When you save the majority of your earnings, you are essentially buying back your time, ensuring that each dollar saved works as an employee dedicated to building your financial independence. The greatest threat to maintaining an aggressive savings rate is lifestyle inflation, which is the tendency to increase your spending as your income grows. When individuals receive promotions, bonuses, or raises, the natural human reaction is to upgrade their living conditions, buy luxury vehicles, or dine at more expensive restaurants. This behavioral trap expands your mandatory baseline expenses, which simultaneously increases the total portfolio size you need to retire. If your income doubles but your expenses also double, your savings rate remains exactly the same, effectively keeping you trapped in the same timeline. Recognizing and actively fighting this psychological hurdle is critical because keeping your cost of living flat while your income climbs is the true catalyst for rapid wealth generation. To successfully implement this strategy, you must adopt a pay-yourself-first methodology by routing your savings and investments directly to your brokerage or retirement accounts before you even see the money in your checking account. When a raise or bonus occurs, redirect 100% of that additional income straight into your investment portfolio rather than letting it creep into your daily spending habits. You can also implement a budget rule where you live on a fixed amount and save any leftover capital, adjusting only for inflation and not for luxury. This deliberate separation of income and lifestyle expenses allows your savings rate to compound alongside your earnings, effectively shortening your retirement timeline from decades to just 10 years without requiring drastic sacrifices in your day-to-day happiness. Part 3. Investment vehicles and compound interest. To reach your financial independence goal in a decade, you must deploy your capital into investment vehicles that offer a solid historical return with low fees. For beginners, broad market index funds and exchange-traded funds tracking major indexes like the S&P 500 provide instant diversification across hundreds of the largest publicly traded companies in the United States. Intermediate investors might complement these core holdings with dividend growth stocks or real estate investment trusts to generate a steady stream of income. Advanced investors can look into tax-efficient asset location strategies, utilizing both taxable brokerage accounts and tax-advantaged accounts like a Roth IRA or a traditional 401k to maximize net returns and minimize the drag of fees on their portfolio. Compound interest acts as the primary engine, accelerating your wealth over this 10-year timeline. When your investments generate dividends or capital gains, those earnings are reinvested, creating a snowball effect where you earn interest on your original investment plus the accumulated earnings from previous periods. Over a span of 10 years, the difference between simple and compound interest is substantial, as the growth curve becomes exponential rather than linear. For example, if you invest a consistent amount every month at an average annual return of 7%, a significant portion of your portfolio total value in the final years comes solely from the compounding of your previous gains rather than your direct contributions. To put this mechanism to work, you must automate your investment process so that your funds are deployed immediately upon receiving your income, eliminating the temptation to spend the money. Choosing low-cost index funds ensures that you keep the majority of your earnings instead of paying high management fees to active fund managers. By consistently reinvesting all dividends and maintaining your contributions, even during market downturns, you allow the power of compound interest to work uninterrupted. This disciplined approach ensures that your capital works just as hard as you do, allowing you to bridge the gap between your current financial situation and the portfolio size required to retire in 10 years. Part 4. Tax optimization and expense reduction strategies. To optimize your tax efficiency during the accumulation phase, you must focus on utilizing tax-advantaged accounts to lower your taxable income, such as a traditional 401k or traditional IRA. By contributing pre-tax dollars, you reduce your adjusted gross income, which allows you to keep more of your hard-earned money and deploy it into investments rather than paying it to the government. For intermediate and advanced investors, this also opens the possibility of utilizing tax loss harvesting in your taxable brokerage accounts to offset capital gains, or implementing a Roth conversion ladder once you retire early. Managing your adjusted gross income strategically allows you to stay in lower tax brackets and even qualify for healthcare subsidies under the Affordable Care Act, significantly reducing your out-of-pocket medical expenses during early retirement. Reducing your ongoing expenses requires a thorough audit of your largest budget categories, particularly housing and transportation, which often consume more than half of a household income. To drive your savings rate to the required levels, consider optimizing your housing situation by house hacking, refinancing a high-interest mortgage, or downsizing to a more affordable living space. For transportation, owning multiple luxury vehicles or frequently upgrading your primary mode of transport introduces massive opportunity costs through depreciation and high insurance premiums. Instead, opting for reliable used vehicles or utilizing public transportation can free up hundreds of dollars every month that can be directly invested into your retirement portfolio. Beyond major expenses, optimizing your recurring monthly bills and discretionary spending forms the foundation of a sustainable early retirement plan. Review your subscriptions, utility bills, and insurance policies annually to negotiate better rates or eliminate services you do not use, ensuring your money is directed toward wealth creation. Advanced strategies involve utilizing health savings accounts, which offer triple tax advantages, meaning contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are never taxed. By combining rigorous expense reduction with sophisticated tax planning techniques, you accelerate your journey toward financial independence, allowing you to reach your 10-year retirement goal without sacrificing your long-term financial security. Part 5. Building and scaling passive income. Generating alternative revenue streams is essential to accelerate your journey to early retirement and reduce the total reliance on your investment portfolio's growth. Passive income allows you to create cash flow that covers your living expenses, effectively lowering the target number you need to reach before leaving your 9-to-5. For beginners, creating passive income might involve launching digital products or leveraging affiliate marketing through social media platforms, requiring little upfront capital but significant time to establish. Intermediate individuals can scale these efforts by automating sales funnels, using email marketing software, or outsourcing content creation, which frees up time while maintaining consistent revenue. Advanced investors can look into real estate investment trusts, automated dropshipping, or even digital courses that teach high-income skills, generating substantial monthly earnings without requiring active management. The process of scaling these assets begins by reinvesting your early earnings into marketing tools, better software, or additional content creation, rather than pocketing the profits immediately. When you treat your passive income projects like small businesses, you can test different offers and optimize conversion rates using data-driven strategies. As your income grows, diversifying your channels protects you against market fluctuations or platform changes, ensuring a stable baseline of cash flow regardless of the broader economy. Building a portfolio of multiple income streams requires patience and consistent optimization, but the payoff is an accelerated timeline to financial freedom. This approach drastically reduces the pressure on your stock market portfolio to bear all the weight of your living expenses during your early retirement. To implement this into your daily routine, you should dedicate a few hours each week to refining one specific project before expanding into new ventures. Start by identifying a problem you can solve for a target audience, whether it is creating financial templates, writing an ebook, or establishing an informational blog around a specific niche. As the platform generates revenue, track your metrics closely to determine which streams provide the highest return on your time and money, and double down on those proven methods. By integrating these scalable passive income streams alongside your primary investments, you create a dynamic financial ecosystem that accelerates your journey toward leaving the traditional workforce and living life on your own terms. Retiring in just 10 years is not just a pipe dream. It is an achievable reality when you align your aggressive savings rate, strategic tax planning, and diversified income streams with the unstoppable power of compound interest. By taking control of your financial baseline and refusing to let lifestyle inflation derail your goals, you are actively buying back your time and creating true independence from the 9-to-5 grind. If you found this step-by-step blueprint valuable and want to continue building your wealth, make sure to hit the subscribe button and join the Sam Invests community for more actionable financial strategies tailored to your success. To help me understand what resonated with you the most, leave a comment down below sharing your favorite financial quote or lesson from today's video, and let me know which step you will implement first to accelerate your own path to early retirement.